All right, thank you, Michael, Ryan, everybody else that was involved in asking me to present today. Real quick history. This came about because on my website, some of the guys that run the Los Angeles chapter of the American Association of Individual Investors, the AAII, the president there contacted me. He'd been using some of the things that he'd found on my website, and they asked me to present to their group. And they have the Los Angeles chapter of that organization is actually the biggest in the country. And I completely wasn't aware. They do a monthly session, some other breakout sessions, but they have a monthly session up at the Skirball Center. And they asked me to present up there, and they asked me what topic I wanted to talk about. So I was about ready to publish on my website some commentary and what I call a scorecard of robo-advisors. And I put it out there, and I said, this kind of got a lot of attention right away. And they said, that's a great topic. Why don't you present on that? So I did a presentation for their LA chapter up at Skirball. Big group, beautiful facility up there. And they partnered me with Mark Harbour, past president of the CFA Society. So after that presentation, Mark asked me if he talked to the private wealth management group here and considered presenting here. So I already had the presentation, although the prior presentation was focused on individual investors. This is going to be more focused on the advisory community. So again, thank you for everybody for coming today. Nice to see a relatively good turnout from what I hear for these sessions, but hopefully I'll make it all worth your while. It's a very interesting and timely topic. In fact, I'll start out with two sides of the commentary that you might see out there. This is from a Folio Dynamics white paper, the one on the top here. The biggest buzzword in the financial space is robo-advisor, thousands of articles, interviews, tweets, etc. This morning, I don't know how many people get the Financial Planning magazine email. Today, I think today's email, 3 of the 8 link list articles had robo in the name. So I see these waves of robo commentary. Everybody's talking about it. Is it too much hype? I don't know. I'll show you the page that I put up that got a lot of attention a few months ago. Just last week, on the bottom here, Steve Wallman, who's at Folio FN, which is one of the original what we'd call robo-advisors. I'll talk about the term and the derivation of it and what it means. He had a commentary last week basically saying that Merrill, Morgan, all these firms have trillions of dollars. If you take all the robo-advisors, depends on how you define robo. We're going to talk about that, how you define a robo-advisor. But I love this quote. Saying that robos is where the industry has evolved is like saying the oceans have evolved into swimming pools. So two different perspectives in a way, saying these guys are so small, are they really threatening the massive business? However, all this news is coming out, these guys are definitely growing and a lot of things are happening. I think we've had a little bit of an inflection point last few months with the introduction by some of the custodians. So let's go back and talk about the history. So how many people were in the industry before 1996 here? Most people? Probably about half the people. So 96 was the year that I finished the CFA. And I started my website. And my website, frankly, had a lot to do with CFA material. And what I was seeing being published on the internet, I saw this opportunity to say, there's this new wild west of the internet, all these new investment products coming out that are going to be internet based. So I put up this website called Investor Home. And I just finished the CFA. I was feeling, I guess, a little bit, I wouldn't say arrogant, but confident. I started emailing a bunch of well-respected professors and saying, I put up this commentary on mutual funds. I put up this commentary on my website. Take a look. Let me have any thoughts. So I went back to my file recently and I read through some of the people that I wrote to, and I was like, wow, I can't believe I actually emailed that guy 18 years ago. And I had completely forgotten some very prominent people, one of which was Bill Sharp. So Bill Sharp wrote back to me and he said, I think the quote was, your website is a treasure trove of information, thank you. So I emailed him back. I said, do you mind if I put that on the website that you said that? That'll give me a lot of credibility. He said, absolutely, no problem. So shortly thereafter, news came out that he was starting this company called Financial Engines. So financial engines is really, you could make a debate about whether financial engines was the first. I'll talk about a couple of the other ones that were out there at the time, but there was a little bit of a rush, and you can see on this bottom quote here, Rick, I think it's pronounced Meigs, I emailed him and I had seen this quote. He talks about there was a big rush in the late 90s for a bunch of firms to try to start an online business. And Bill Sharp really did it, what I would say the right way. He had this perspective of having worked with pension funds as a high-end consultant, really some of the biggest money managers out there. A lot of people consulted with him. He said, this internet's going to change the game. Let's make a product where individual investors can go in, run these fancy Monte Carlo simulations, all these other things. Some of you may have seen them. I remember I tested it through, I think Vanguard gave me a free trial. But before they launched the website, Bill, sent me an email. I said, take a look at it, and I looked through it, and I found some typos before they launched. I don't know, they probably would have caught it anyways. Made me feel important, I don't know. But I got to see financial engines launch, and they really are the genesis of what we would call the robo industry. One of the reasons that I started publishing information about the industry was because I keep seeing all these articles, and every one of them lists a different group of companies. There's so many of them that I said, this is so confusing. Why does the Wall Street Journal list these 5 firms? Why did Kiplinger's have these 10? Why did all these different firms have these different lists? And I started putting together a list one by one and saying who's been mentioned where, so I can make this list and then kind of have some way of ranking all these firms, because there's so many of them and I couldn't get my hand. I was just getting a little bit frustrated, and I got frustrated that a lot of them were writing articles and not even mentioning financial engines, and I'm like, why is everybody writing about these tiny little firms? Financial Engines was the one that really started this thing. So most of you are familiar with them, but they IPO'd in 2010, which is around the time a lot of these other newer companies started, probably not unrelated. And today, Financial Engines has a market cap of about over $2 billion. They manage over 100 million. I've seen one list of RIAs. They're at the top of the list because they're just huge. Whether they want to be called a robo-advisor, I've never seen them comment on it. They're not very public about stuff like that. But they're basically in the plan sponsor world, and they found the niche. As he mentioned here, they didn't find a niche doing what's happening now, which is individuals going straight into the product and paying for it, X number of basis points or as a service. They found their niche through the plan sponsors, getting these relationships through all of their plan participants, and providing the service through that. And now they're the big, one of the big players. There's another company, I was trying to research who didn't make it from that original group. The main one, as far as I know, Direct Advice raised $16 million in venture capital, and they're no longer there. So I don't know exactly what the storyline was, but they tried to do this idea of automating, investment advice over the internet. Didn't make it. Empower is probably the other company that has a claim to being really the first. I'm not sure which one launched first. I wasn't as familiar with them. Empower was acquired by Morningstar in, I think it was 2003. Okay, so where does the robo-advisor term come from? So Business Insider had an article. They went and they researched this. This made my job a little bit easier. I found this recently. They found an article by Richard Corretto. Anybody know his background? I emailed him, he didn't respond to me. But he wrote an article apparently in financial planning, and he used the term robo-advisor, and it talked about Empower and financial engines. But that wasn't the point when it caught on. So Bill Winterberg, I don't know how many of you are familiar with him. He does a lot of blogging and video stuff about the investment advisory community. He's in kind of that space, the internet space of building a business in media for investment advisors and stuff like that. So he started using the term in 2012, and that's really the point when the term robo-advisor kind of took off. And he's got the proof of it at this link. He's got his presentations just like this, where he was talking to people in the industry and talking about the robo-advisors and discussing it right there. Okay, so big question. Is robo-advisor a derogatory or negative associated term? Personally, I've tried to come up with why it would be positive or negative. I hate robocallers. That's definitely a negative. RoboCop, I don't know, he was a good guy, right? I didn't see all the movies. Some of them were good, so I don't know whether it's good or bad, but I just took a couple sampling. Alan Roth, who's a relatively writes a lot, gets a lot of press. He wrote an article that said robo-advisor is derogatory. But Bill Winterberg, the guy who really is responsible probably for the spread of the term more than anybody, he wrote an article, he says to those guys, boo-hoo. It's just the perfect moniker for what they do. He says, this is just the right term, don't complain about it. Okay, so who's complaining about it? So I told you, I mentioned I made a presentation at the AAII, and Jacqueline McClellan had written a very good article, one of the best articles about the robo-advisors, and it was in the AAII journal. And she contacted many of these firms. And in fact, one person that I contacted before I launched my commentary on it said, you really should contact all these guys and ask them how they want to be portrayed and stuff like that. And I don't have time. I'm not going to go contacting all these guys. She really did the legwork for me when she wrote this article. She contacted them all, asked them how much they charge, all the background information. She had like the biggest list really that I've seen of like 14 of them. And regarding the term robo, do they like it or not? She, asked them specifically, and Wealthfront, Betterment, Hedgeable, Personal Capital all had these comments to her in her report that were in effect, we're not crazy about it. It's, it's really the financial industry's moniker for us to try to, make us a commodity or less impressive. Some of the others, Covestor and Trade King Advisors, I guess did not, have a problem with it. And others have a different approach. Whether they like it or not, others are saying we're just not robo-advisors. So for instance, Vanguard is saying they're really a hybrid. And that's really where you're seeing a lot of action, is people moving into this hybrid of saying, we still have access to an advisor. We're not completely automated, but you get both. You get the advisor and you get the automation where it's appropriate. And that's where you're seeing a lot of action. And Motif is another one that says they're not, and I'll talk a little bit about that. So a lot of things happening. It's slowed down a little bit, but there's really a lot of action. There's a lot of commentary. There's been some mergers. We don't necessarily expect to see a lot of these smaller operators merging, but some of them have been getting bought out for various reasons. I talked about the term robo-advisors. The question is, how do you define a robo-service? So Wikipedia says it's a financial advisor that provides portfolio management online with minimal human intervention. And you talk about things like target date funds and other types of products, which arguably would be similar in that they're trying to focus on asset allocation, use index funds, just basically give you a diversified portfolio with an appropriate asset allocation that's going to rebalance on its own. Arguably, a target date fund is doing that within the fund, whereas now the robo-advisors are doing that in your individual account. But theoretically, there's no reason why a firm that offers both of those products wouldn't have the same staff working on the same product, doing the same calculations, et cetera. So a lot of people have been commenting about, how do you segment the robo-advisors? I'm going to talk about a couple of other studies here, but this was one talking about are they a threat? So there's very conflicting information I've seen from a couple different studies about whether advisors consider the robo-advisors a threat or whether they're an opportunity in terms of the technology side. Okay, so let's talk about how do we separate these firms? How do we try to group them into different products? Because there are a lot of ways they're not very comparable. So this was one comparison that I saw. He talked about you can segment the robo-advisors into pure technology sites, companies that include advisors but who use the technology, and they list a couple of them over there, and then established firms, Vanguard and Edelman, that recently expanded. So that's from a little over a year ago, one person segmentation. Jack Weimeyer has a website called the Paladin Registry. Some people may have seen that. And he's kind of been commenting a lot on this space, and he kind of separates them into these 5 categories. So we have different people kind of trying to segment these firms into different groups. And this is also from Weimeyer. He talks about, so now let's talk about how we separate a robo-advisor from a financial advisor. So I've got some other slides on this later. I'm not going to read them individually, but obviously they tend to offer lower costs is one of the big ones. But this is a little bit of a segmentation from his perspective of what's the difference between a robo and a traditional advisor. So, sure.
A quick question on that last front. I read an article 3 weeks ago in the journal about how nowadays, of late, you have some robo-advisors moving into an algorithmic-based advice for trust and estate planning as well.
Mm-hmm.
I'm not sure if you read that or not.
I know the Wall Street Journal article, the fairly big one that was out. I'm not sure about the specific comment there. So fill in a little bit more of the background. When I mentioned that I was about to put out some commentary, what happened was I was reading all these articles and I said, I'm just so frustrated seeing everybody listing a different one. So I finally started building a table and said, who are these guys? Let me try to rank them, do something with them. So this is what I basically put out. I basically made each one, and then this was in March. And March 31st, of course, is the date when everybody has to update their ADVs. You have to disclose your discretionary assets under management. Not everybody did, actually. But generally, everybody updates their ADVs. So every one of these that's an investment advisor, I was able to go in on April 1st and say, OK, here's a point where I can go in and compare these guys on one metric. At discretionary assets under management. It's not the best term for some of these, and I'm sure some of these don't like this table because of that. I'll go into some of those a little bit later. But this allowed me to, in effect, say, make a list of all of them and then rank them by approximate. I've updated this. I have what I did originally from the end of the year. Some of these guys have been updating this every month because I think one reason is if they have to update their ADV for whatever reason, they're just updating it anyways. Some of them are really in this foot race. So these guys are constantly trying to one-up each other, Betterment and Wealthfront. So they're constantly saying, oh, we got a little bit more. Oh, we're up to 2.5, et cetera, et cetera. So I put together this table, and this is what I put out. And I sent out a few emails, and it got picked up relatively quickly. Jason Zweig at the Wall Street Journal tweeted it. Tadas Visconta, who has a pretty good daily blog link list, put it out, and it just kind of picked up. It did. I wouldn't say it went viral, but a lot of people started jumping on it, and I started getting emails from some of the custodians and other people, and got a lot of traffic. And I don't pay attention to traffic because I don't have an advertising model, but a lot of people were looking. And I tried to, kind of get some kind of idea about what their costs, what they're charging. So I thought this was, a lot of other people are putting in what's their minimum, what's other stuff. I thought for me it was interesting to see as you go up the scale for 100 to $1 million to 10 million, what are they charging people for their service? So this table kind of got a lot of attention. And Michael Kitsis, who also writes and blogs a lot in the industry, tweeted out, very interesting list. And he said, but these are not all robo-advisors. So this gets back to what's the definition of a robo-advisor. And my response to him was, I agree. These guys are not comparable in a lot of different ways. The question is, how do we start segmenting these? And that's kind of where I got to this point. Like my response to him was like, we're kind of comparing apples and oranges. So I was looking for, okay, what's a hybrid? You can't really, there's no hybrid between apple and oranges, but I wasn't sure about it. But apparently a pluot is a merger of a hybrid of a plum and an apricot. So in a way, I kind of put some of those in this category, and I put some of them in these categories where they're kind of stapling together half traditional advisor, half robo-advisor. So just mentally for me, I thought it was a fun analogy to kind of put out there. Every one of these articles, I'm getting a little frustrated because a lot of them have like all these graphics, and this one I thought was kind of funny because it's kind of just a robot with a human head or a human with a robot head. Another little funny thing. This was, to me, one of the first times I saw somebody trying to do what I was doing and say, how do we kind of rank these guys? And I still haven't kind of gotten my grasp of this, but for a presentation you got to put in some graphics and other stuff because some people are more inclined to look at figures like this, and some people like just text. But I thought this was interesting. Yeah.
Is LearnVest still around? Did they get bought by somebody?
They got invested in
Northwest Mutual.
Yeah, that was a fairly big price, so I think that was a strategic opportunity. But yeah, so this is a little bit old. So I just liked it because it was the first attempt to say, okay, how do we compare these guys versus investment management or financial planning? I'm not sure that's the best metric, but advisor-based versus technology-based, that's definitely part of the factoring here. Whether you go up or down this scale and whether you're a hybrid in between the two. It was an interesting graphic, and I'd like to see him, updated it, but I just thought it was particularly interesting. So you saw my list. I've got about 60 firms that I don't have on the grid, but that I've listed, that I've seen mentioned, or that arguably are in this robo-advisor category because somebody's mentioned them or they're in that space. There's a decent number of them that are software providers, and a lot of those are focused on the advisory community. They're not direct to consumer. But you do have a lot of these companies that are offering both. They've got a direct-to-consumer product, and they're now offering their technology in some way to advisors, the thought being that advisors still control the relationship. We'll see some other comments about that. So they're in that space, and it's just a big group of firms that are really fighting it out right now. Okay, so what are some of the notable firms? Folio FN, you saw the quote from earlier, was one of the earlier ones. They started not when Financial Engines and Empower started, but they're different. They're, like I say, they're not. You can't compare them apples and oranges. Folio FN is a brokerage firm. They're not an advisor, and they allow people to build portfolios with fractional shares. There's a lot of the fractional shares is really part of the issue here in terms of being able to have an individual investor do things that they couldn't do before with an account through Folio FN. Motif is a similar. They're trying to allow you to saying like I like pharmaceuticals. So you can an individual investor can go put together a small portfolio with fractional shares, made up of basically what would traditionally be a style fund or something else comparable, but they can do it individually through Folio FN. Robinhood is a zero commission broker, so they're kind of mentioned within this space, but they're clearly not comparable to most of these firms. One of the most interesting ones is Acorns, which actually happens to be based here in Newport Beach. Not a lot of these firms are in San Francisco or New York. This one's actually here, started, I don't want to mispronounce their name, so you can research them individually. But they're down here in Newport. They are an app on your phone. And they've got hundreds of thousands of people that are already using it. And if you think about it, the analogy is great. This was really a fantastic idea. That you start by making small contributions potentially every day. Basically, it's an app that says, it's not a new idea, but round up the dollar. Every time they make a purchase, if you sign up for Acorns, they round it up to the next dollar. That rounding amount goes into your investment account. So the banks used to do this. I don't know how successful it was. So you could build up a bank account by rounding up to the dollar. Now Acorns is doing that. You don't even have to ever go to their website. It's just on your phone. You sign up. You give them. It's through your credit card, basically. Anybody using it?
I have a friend that uses it.
You have a friend that uses it. Yeah. This was a few months ago. They already had 650,000 members. They raised $23 million in April. So the guys that have been around for a while, most of those big fundraisers were last year. This is the biggest one that I've seen recently. And I don't know that they're not a traditional robo-advisor, but they're going to get big. They were, when I put this together, they had like 23 million in their ADV, and I checked yesterday, they're up to 55. They're going to start growing hundreds of millions relatively quick just because they have so many people doing it. If I was them, I'd start thinking about, okay, you got that investment account. A lot of these people have more money somewhere else. Eventually, there's going to be an opportunity to try to do a bigger product, or they're going to become a takeover candidate. Just the fact that, to me, that's the most interesting thing, that here's a company that's really in the investment advisory space. They're making money from the 25 basis points on the account. And they got Harry Markowitz to design the 5 portfolios. So they're saying you're getting a high-end product here. You're just going to build it up over years and years and years. And the fact that they're catching on so quick and they're on your phone is a little bit of a game changer. So
the family name is the Custodians.
Correct. See, I would have mispronounced it. It's a good thing I waited for you.
I think where I met with those guys, and I think what they took from it, so it's father and son. So the father had a brokerage, traditional brokerage in the 90s, and sold out to his partner.
Right.
But they really led it from a technologies for Silicon Valley, even though they're in Newport Beach. And where the traction has come is with millennials, because the technology is ease of use, and I think most people are intimidated by financial planning, and they've tried to hit that on its head, which is a little different from some of the other guys.
Right.
That's probably why you're seeing traction.
Could be. Well, I'm sure it's multiple, not one reason, but great idea. I just, for me, they're one of the most interesting firms in this group. Okay, the ones that you hear about, Wealthfront and Betterment, they're both over 2.4 billion. It's taken them a while to get there. They're not growing that fast. There was an article in MF Wire. There's been a few commentaries, and I've got a couple of them here. Another one, another slide talking about this. When you do the numbers, it's going to be, both of these companies, I think they list like 85 or 100 member staffs. So they got pretty high burn rates. And if you do the math, they're going to have to raise a lot of money to get profitable. But there's clearly the VC community has been willing to spend a decent amount of money on them, because you can see these numbers. That's what this MF Wire article talked about, that the valuation on Wealthfront was 700 million, Betterment was 400 to 500 million for those fundraisings. Those are big numbers for companies that only have $1 billion or $2 billion at the time. So there's clearly bigger issues going on than just trying to value it based on the assets that they have under management here. So I mentioned that some of these firms I think would disagree the way that I've ranked them on discretionary assets, and I'm not saying it's a great measure. It's just, for me, I wanted to put them together on the same grid. So these are some examples of firms that, it's not discretionary assets under management. Even within our industry, not everybody's after that figure. But Sigfig, this was just a little while ago. They oversee 350 billion. It really depends on the product, how they're talking about this. Hedgeable says that 474 billion assets under advisement. Again, so these are not accounts where they're getting a management fee, but they're interacting with all these accounts in some way, which the question, how do we compare that to a traditional wealth management relationship? Market Riders is more of a subscriber-based product. So they're saying that they used a different term, and when I checked yesterday, I took it out because they didn't use that exact term. I forget what they had said. But now they're pretty straightforward. They're saying the people that use their service have about $5 billion according to their calculations, because I guess people are probably saying what they have and to do the analytics, and then they're giving them some kind of recommendation. So again, there's no perfect way of comparing all these, because they're apples and oranges and bananas and pluots and all these other different varieties of fruits, at least my analogy. Okay, so let's talk about some of the other players now. So a lot of commentary, a lot of talk about what Charles Schwab is doing. So particularly if you custody with Charles Schwab, they've now rolled out their free robo-advisor to customers directly, and they're also offering a service to their advisor network. So I think the number was, if you have 10 million or more in custody with Schwab, they're giving you that product, which I'm not sure what percentage of advisors that use Schwab as their custody would say it make.
They have more advisors custody with Schwab than any other.
Right. So my question is, what percentage of them would say, I want to put my customers into the Schwab robo-advisor product, which is basically saying we're generally going to be buying Schwab funds. So I have no idea what the breakdown of the similarity between a traditional Schwab custody advisor and the Schwab robo-advisor recommended portfolio. So, Schwab has been, they obviously, because they're now competing with these other firms, these guys are kind of jabbing at it, and there's a lot of commentary. You might see it if you're online like me, you see a lot of these guys catfighting through their blogs or through commentary in the press about what they're doing. And Schwab took a lot of heat because people are saying, well, they're giving it away for free. It can't be free. You don't get anything for nothing. Obviously, the big target was Schwab is keeping X percentage in cash. And obviously, they can lend that out and they make money with their cash balances. To me, it's relatively obvious, because they want it because they're putting people into Schwab ETFs for the most part. So they make money on the ETF. Even though their costs are generally relatively low, but the fact that they can get somebody in with this product, we'll talk a little bit more about it. What's the difference between what all these guys are spitting out in terms of their recommendations, the ETFs they're using, the other funds they're using, et cetera?
What is the feedback you're hearing from advisors as you're giving this speech or this presentation? Who custody at Schwab?
I haven't talked to a lot of advisors specifically about that yet. So, like I say, there's a lot of periodicals that are oriented towards the advisory community, not the public. So I'm reading what those guys are writing. I threw in a couple of other things. Obviously, Schwab realizes they're kind of walking a tightrope here. So this was a comment from Schwab's CEO, Bettinger, about, I don't know if that's the right way to pronounce his name. He's basically saying, we're never going to get rid of the high-end advisor. He doesn't want to piss everybody off. They don't want to piss everybody off, obviously, because that's a big part of their business. But there's clearly this issue of they're offering this product. They're offering the product to the advisor. And theoretically, people have different choices now that weren't available previously. I just put this in here because it's from a Schwab study. This is kind of an interesting way of thinking about what's going on here with this new technology and robo-advisors. So, this is interesting that, I don't know how long ago everybody used a travel agent. Now, 96% of people are comfortable booking a flight online, planning a vacation, researching a new car. So we're now talking about how comfortable are people having their investment advisory account managed online by a machine. So it's a relative important discussion to have at that point. A couple other firms to keep your eye on. There's some shifting going on. There's some seemingly inconsistent things happening between year and year. Fidelity has some agreements with a couple of these firms. Fidelity is a little bit similar. They've got a lot of custody, get a lot of advisors using the network. They've got a lot of customers on their own. So I think they're definitely spending a lot of time figuring out what their ultimate approach is going to be here. TD Ameritrade was very interesting because when I put this up, they were saying things like this: we are not going to pick a single horse. We want to be the stable. Interesting analogy. They're saying, we're going to see how these guys weed themselves out and then offer the best one to our customers, potentially our advisor network. But just recently they announced they are developing their own robo-advisor service.
So I just met with Fidelity on Monday.
Yep.
They told me they had $200 billion through their affiliate strategic advisors. That's their discretionary managed account subsidiary.
Mm-hmm.
That is a competitor to financial engines for plans that they are the record keeper for.
Right.
And so they told me they had $200 billion in assets through strategic advisors, and it's pure algo. No humor. It's just as it is with financial engines. Interesting. Yeah, because they haven't been in the press a lot, and they're kind of keeping back, and I haven't seen what they're saying. LPL is another very interesting one. They were one of the first players. There was a company called Nestwise that was previously called Veritat. They bought it, and then they tossed them out. They said, no, this isn't going to work. So that was a case of LPL. Is there anybody with LPL here? I was actually hoping we would have somebody that's affiliated with them just to hear what they're hearing on the inside. Yeah, LPL has traditionally LPL draws from the brokerage community, so it doesn't surprise me because CFAs are usually not Series 7, they're more usually on the RIA side. But LPL bought this firm, and then I don't know whether there was some kind of conflict internally about what's going on here with all these conflicts between the customer direct or having a service, but they killed it. So they just announced a week or two that they're now getting back into it. So we'll have to see what that's going to be. Again, a lot of these things are developing, and all these guys are obviously internally trying to decide how to approach this. So there's obviously a lot there. Merrill Lynch has this Merrill One. They're traditionally not mentioned in this space, but they have this product for the lower end of their customers. And we're talking about some big numbers there. So it's worth just mentioning. I don't kind of consider them in the robo space. They're not creating an algorithmic program. They're just allowing their customers that they don't feel are going to be profitable enough to be with one of their advisors to have a platform. But it's worth keeping an eye on, et cetera, and they're obviously one of the big players. Wells Fargo recently said they may develop a robo, and there was some mentions in one of these two articles about them working with financial engines. And financial engines has a lot of relationships. They're in a lot of different places, so there's different cross currents going on in different ways. This was, and I threw this in there because it was a Wells Fargo survey. The headline here was, your clients haven't even heard of robo-advisors. So again, this is on the, is this big or is this not? This was kind of trying to say, it's not so big. People with 250,000, most of them, they're not following it. They don't know about it. So again, it's a question of,
I don't know if the bigger question is where are we now in terms of people being aware of robo-advisors. The question is where are we going to be going forward and how big are these guys going to get. Okay, so now the big player. So this is when I mention a big turning point in the industry. So here's Vanguard. So for the last 2 years, Vanguard has been betaing this personal advisor services. I have money at Vanguard. I got the letters. I don't know if anybody else has money there. You get these letters. We got this new service, personal advisor services. You still have access to an advisor, most likely a CFP. Ooh. But we're talking some big numbers. Last quarter, according to this article, and Brooke, I don't know if anybody reads RIA Biz. I've talked to Brooke, and he's one of the sharpest commentators on our field in this space. I haven't seen it officially, but he says $4 billion last quarter went into this product. So if you think about Betterment and Wealthfront have $5 billion, I don't know how much of that is from growth of the portfolio, but those are pretty similar numbers. Vanguard in 1 quarter raised what probably Betterment and Wealthfront have raised in their existence in terms of new money. So this is the elephant in the room here, Vanguard.
Just like the Fidelity that Nate was mentioning and Financial Engines, I've seen Vanguard with a couple clients through the 401k space. And they sent like 3 mailers within 2 months to somebody that's worked for a large firm, and their advertising for it was, your employer has specifically chosen us, your employer thinks this is a great idea,
right.
We want to offer to you at a cut rate because your employer thinks that you can benefit from this. So that, through the 401k spaces,
I think they use Financial Engines as their managed account provider for their 401k plans.
they do, but they were selling this to their 401k plan. So it looked like it was displacing Financial Engines.
Yeah, so.
Or at least for that employer that I saw.
Well. So I'm going to go through some slides fairly quickly because we're.
Question, on the last slide, was that a decimal point before the 30?
30 bips.
It's 30 bips. Yeah.
And you still get an advisor for financial.
Right, and it goes down. They've got a sliding scale. You start getting bigger numbers, you get an even smaller percentage. And again, Vanguard is making that fee, but you're pretty much invested in Vanguard funds. So, but you got to always just remember, Vanguard is not a profit-seeking oriented firm. They're still a mutual-owned organization. They're not necessarily trying to make it as profitable as possible. They're trying to match up their revenue with their expenses because they're not a for-profit organization. This is a quick study. There's a little subtlety between this one and I'll show you the next one. If you had to choose between a portfolio based on an algorithm or developed by a financial advisor, so this is one or the other. This is how this study's numbers came out. So these are not insignificant numbers. This is that percentage of people say, I don't even talk to an advisor, I'll just take the algorithm. That's a pretty significant number. Gallup recently came out with a poll that asked it more in the hybrid approach. If you had to compare one or the other or both, how do the numbers break out? So Gallup is a little bit not, they're saying not one or the other, how do you break it down? So these are some pretty interesting numbers, and you can find, I don't know if we're going to put this up, the presentation on our website, but certainly I'll email it to you if you email me after the presentation. But this one's relatively easy to find. Just put in Gallup online advice and you'll find it relatively quickly. All this stuff I've got cited in the presentation in terms of where I got this stuff from. This was another study talked about from the advisory community, do you feel threatened? And like I say, I've seen a couple different studies that are different spaces, and depending on the wording, do you feel at least a little bit threatened? Yeah, most people feel at least a little bit threatened. Do you feel really threatened? Most of them say no. So we're in this space of, I think, a lot of people kind of interpreting, is there a threat here? Yes. Is it huge? Not yet. But again, there's different studies here, and part of the countering here is that, okay, now we've got all these different firms that are offering what seem like very similar products. Do we have a commodity here? And now we got Schwab giving it away. So any commodity is subject to pricing pressure, of course. So the question is, Betterment, Wealthfront, all these firms that are purely robo, just trying to do this, is there going to be any pricing pressure, and are they going to be able to make profits eventually? I like this quote too. I could have put this one on the front also. Depending on which article you read, if you're a financial advisor, either the robos will crush you like a Bradley fighting vehicle rolling over a walnut, or you have no more to fear from them than a 5-star restaurant has to fear from McDonald's. Interesting quote, and he concludes both are wrong, or somewhere in the middle there. Nice soundbite, I like it. This was an interesting piece of information. At the end of last year, there was an article, somebody had written a commentary that you have nothing to fear from these guys. I haven't heard about anybody losing an account. And I emailed the writer, I said, I just happened to have had lunch with a multi-billion-dollar principal manager of a firm, and he confided in me, and I don't want to give specific numbers, but he said, I just lost my first big account to a robo-advisor, and it was a big 7-figure number. So I emailed him, I said, his response was, well, I mentioned it, and I asked people in forums if anybody's lost any accounts, nobody raises their hand. And I said, well, that's not a surprise. Who's going to, in front of all their peers, say I just lost an account? He said, yeah, but nobody's coming up to me afterwards and telling me, I didn't want to raise my hand in front of everybody, but I'm getting some competition from these guys and losing. I said, well, that doesn't surprise me either, but this was an actual study that came out shortly thereafter and said, based on an advisor, how many years in the service, people that haven't been in the service, they're in the business for very long, some of them are saying we've lost a large client. Some of them are saying we've lost small clients. But even the guys that have been around for a while, you're starting to see a little bit of bigger clients go. So this is probably stale. The question is whether it's moving aggressively or not. But we definitely have signs that people are evaluating this. And arguably the question is, if we've been in a relatively decent return environment, if we go into a negative or low return environment, whether this number is going to start going up just because people are frustrated and they want to move. I don't know. So back to that question of where are fees going, is this the natural question is, are the robo-advisors causing some fee compression? And according to this, last year, no. We didn't, it's been trending a little bit down. This was from an investment news article. Through 2014, they actually saw a slight uptick. And I haven't looked at where they're getting their data from, the analytics. I don't know where it came from. I just saw it, and I love to put graphics in presentations because some people like them, and they're more intuitive and things like that. You had a question?
Do you think that their technology will become more available to advisors outside of what they're doing? In other words, will there be fee compression to the technology resources that we need? Are we going to see lower costs ourselves?
Well, Schwab is basically giving it away for free.
I'm sorry, I'm referring to the technology, like for example, performance reporting or
performance reporting.
Using that they're now wrapping up into their packages.
Yeah, it's a fair question. Fair question. I don't know the answer to that. This was another one I put in more for individual investors. Most of you already are in this other space where, I've been debating. I correspond with a number of prominent authors, and I had been doing a review for somebody, and he had made a comment about the difference between how much people pay in fees versus commission. And I kind of come back to him. I said, I thought that at this point we were starting to see a flip over of more people using fee-based accounts as opposed to commission-based. And when I found this article, this graphic, that's the inflection point really was, according to this, in terms of where we flipped in terms of more money coming into fee-based accounts as opposed to commission-based. So again, I haven't delved into those, tried to analyze the numbers in either of those graphics, but they're relatively interesting. Just a couple of quick comments. What's the public perception? What's being written out there? These are, some guys that write a lot online. This is typically what we're seeing in terms of what the impression on the public is of the robo-advisors. So Chuck Jaffe wrote this article. The ultimate winner of all this is the consumer, because they're getting good, all these other products, they're getting lower prices, et cetera. Rick Ferry just had an article in the Wall Street Journal. It was a blog also. He had an interesting point. He said, I've said that target dates are relatively consistent. He kind of made the point that there's nothing revolutionary here. You could go to most mutual fund companies, answer a few questions online, and they'll put you in a mutual fund, and there is no cost to that. So what's the difference between a robo-advisor? His point was that it's relatively straightforward in terms of what's happening, and there shouldn't be much of a cost to it because people have been doing it in a different form for a long time. Meb Faber has done some interesting work. He back-tested 3 of them, Schwab, Wealthfront, and Betterment, at I think their most aggressive settings to see what the returns were going back. So he said, according to going back for his data back to 1972, if you were with one of those firms theoretically back-tested with their most aggressive portfolio, he came out with all 3 of them were very similar. So he's effectively saying, doesn't matter which one you pick if you're a consumer, you're probably going to get roughly the same returns. So this gets back to the commoditization issue of how do we differentiate these guys? We're not seeing much of a differentiation so far between the returns, but it's relatively early in the game. According to Meb Faber, on his back testing of what their strategies were, they're relatively similar. And for those numbers, you have to put it in perspective. They were like 10 and a quarter to 10.5% returns, but again, you have to compare that to a balance fund or something for that period and see what the numbers were. His point was that the returns have been relatively similar for the different offerings if you backtest them. There's no real surprise there. He just was one of the first that I've seen actually put those numbers out. So back to the question of whether these guys are going to get to profitability, Morningstar put out some commentary that, I've seen a couple of articles saying, how much assets does these guys have to get to be profitable? Pretty big numbers, because at 25 or 15 basis points, you got to have a lot to justify the kind of burn rate. So that's what these guys are kind of saying, is that they're going to eat through all their capital before they get the profitability. So I don't know if there's any venture capitalists here, but if you had been in one of the latest rounds with one of these, I don't know whether you're feeling like you made a great investment or whether you're going to have a hard time getting your money back. This is just some commentary about segmenting, what's good and bad about robo-advisors, since it's already 1:20. I'm going to try to finish up. Okay, the SEC, I haven't seen much attention to this, but I certainly noticed it. They put out an investor alert. So if I'm an advisor and somebody comes to me and says, why wouldn't I just go with one of these guys instead of you? The SEC really almost answered that question for us. They put out an investor alert saying, be careful with these guys. Number one, don't give away your personal information. Don't give away your password and login for your regular custodian. You'd kind of be clueless to do that to anybody, with anybody, but a lot of them, some of these services go in and ask you to give them your information. And if this is a startup, who knows whether their security is good. You never advise nobody ever give away that information. But
I have to notice something that you didn't announce out loud, but this was put out by the SEC and FINRA. FINRA could have an axe to grind.
Could be. Either way, the main criticism here, though, is, and this is, I saw a very interesting article that talked about one of the advantages of the robo-advisors is that, some of them advertise, don't quote me, but I thought one of them was advertising, in 10 minutes you can be up. And if you think about, there was an article that I read that had a very good point. He said, if you talk about the traditional wealth management industry, think about you get a new lead comes in or somebody comes to you. How long does it take you to get that account up and running? You're going to meet with them, you're going to talk to them, you're going to pitch them, they might come to your office. You might go through this whole progression. Robo-advisor, 10 minutes. Go in, answer some questions. Your account will now be on autopilot for the next 20 years. Okay, so there's some good and some bad in that, obviously, and we don't have time to go into it right now, but obviously, and here's an example. The Wall Street Journal, you talk about a commodity, it's getting really difficult. I would be a little bit concerned if I'm these guys, because they keep answering these questionnaires with the internet. Okay, if anybody wants to find out what these guys are recommending as a portfolio, they've already basically told that to some reporter. So, and the way it happens is that, the Wall Street Journal wrote this article and said, here's some examples of the different questions that they ask. So again, in 10 minutes, you could be up and running in one of these robo-advisors. You're going to get these kinds of questions. My first response is that, number one, if you go through this in 10 minutes and then you go through it the next day or 2 weeks later, your answers might be different. We know a lot now more about behavioral finance. People's perceptions and their risk tolerance change based on multiple factors. So that's a potential issue. in terms of saying, is it a really good idea for somebody to go in and fill out a quick risk questionnaire? It's the same question for any advisor that uses a risk questionnaire. Is when they're sitting there, you want to make sure that they've thought about that, and that's a stable answer, not just something that I did fly of the moment, and then I'm going to use that for the next 5 years to rebalance their account, and I've got my defense because you filled out the form, and this is perfectly prudent to do what I did with your money based on those responses. Quick question?
The last time I checked, the robo-advisors were cash out, meaning you couldn't take an existing portfolio and have them manage it for you according to their platform or keep legacy holdings. Is that still the case?
Yeah, I don't know. It probably depends on the individual. Some of them might have a survey. Financial Engines was originally set up to say what's available to you. I'll analyze all those products and give you a recommendation. And a lot of the ones that are associated with a plan or coming through a plan sponsor or a retirement plan, they obviously are dealing with what's being offered in the plan. So I don't know whether somebody could take a current portfolio into their service. I suspect not, but there's probably some that can. The brokerage-oriented ones probably can, but I don't know. They'd have to answer that individually. So those are the questions. And then, like I mentioned, the Wall Street Journal put out this table, so I lifted it, but I'm saying where I got it from. So hopefully I don't get in trouble for doing this, but Wall Street Journal put this out here, and it's up there. So you want to know what you're going to get if you go through a question and you fill out the similar answers with all these different services, you can get something like that. But they also, MarketWatch ran a similar article, said, okay, we quizzed 4 financial advisors and 4 robo-advisors, and here's what they all recommended. And then they came back a few days later and they said, we're going to give you a portfolio. Can you guess whether it was a robo or a financial advisor that did it? So a lot of this stuff is, like I say, if I was one of these firms, I'd be thinking, can I keep it kind of proprietary what my model is saying? And I don't know, you can, because you're answering questions with all this press. And once somebody puts it out there, why would they, if they can, why do they want to pay me 25 basis points? I guess if they do, to rebalance and do all that stuff and be automated, yes. But theoretically, somebody can mimic it without paying for it and go from there. So again, gets back to the commodity issue of is there pricing pressure and is there much difference between what these guys are offering? This was just funny. It's something I sent to my son. Another criticism potentially of robos is probably a little harsh. This is one of those robotic vacuum cleaners. And in South Korea, apparently it's common to sleep on the floor. So if you have a robot, you don't want to do anything that's going to put you in jeopardy because she went to sleep on the floor and apparently her vacuum cleaner went off and got caught in her hair and she couldn't get it to stop. And just funny graphic that I wanted to throw in there. Okay, there's one other aspect of this. Some people have argued that the point of the robo-advisors is to address the behavioral gap, meaning we've known for, ironically, around the same time that the robo-advisors started was about the time we started hearing reports about the difference between time-weighted and dollar-weighted returns and the fact that investors are consistently bad in their timing and therefore returns usually don't actually match up with the returns from the fund because they go in and out at the wrong time. So arguably, some of the robo-advisors have been marketing their services saying this is what we do for you. We prevent you from falling into this trap. And most CFAs, I put this together more for the individual investors, but it's still a relevant discussion that Morningstar does the annual Mind the Gap column, and Dalbar gets a lot of press from their same thing, although theirs has been criticized for some of the methodology. But we have all this data, and that's part of the marketing angle of some of these firms is that you're going to avoid this problem of going in and out of funds at the wrong time because we rebalance it and prevent you from doing that. So it's part of the discussion. And as my last slide, since we're pretty much out of time, what's going on right now is we have the fiduciary debate. So the Department of Labor actually has hearings, next week? August 10th and 12th. I was at a presentation on Friday and was pretty solemn about preventing this thing from moving forward. So their impression was that these guys are going to steamroll through with this Department of Labor fiduciary standard, even though Vanguard, Fidelity, BlackRock, all of them have come out with significant criticisms, although from a CFA perspective, we believe that the client has to come first. But a lot of these firms are saying, I don't know if this is the right way for the Department of Labor to do it instead of the SEC, which apparently is locked at the moment. So That's what's going on right now. The interesting thing is that this was actually a video on the Wall Street Journal. I just sort of cited the guy who mentioned this, but the argument that one of the arguments that the industry has been using against the fiduciary standard is that they won't be able to afford to continue to service small customers. So the point, and I had thought this, and then this guy actually articulated it. He basically said, well, and Perez, the DOL, the guy who was running the show here at the DOL, has basically been saying, we have these new services like Betterment and Wealthfront that are going to service smaller accounts. So what's the problem? They just won't have to go to a bank or a wirehouse and pay a load or some other kind of fee for you to service them. We have these other options. So he basically made the point on this Wall Street Journal video that the robo-advisors are kind of taking a little bit of air out of that argument that it's going to be costly and that small investors won't have a place to go, because that's where the robo-advisors really are focusing, is small investors, and they're going to have an opportunity to build up an account. And when they get bigger, hopefully they come to you or me or one of us, because they need more advice than just the robo-advisor. Questions? I think I used up all the time, but we had some questions interlaced there.
As far as you've seen, when these robo-advisors kind of dictate an asset allocation, it's just a questionnaire. There's really no formal IPS, right? There's no goal stated, there's no unique circumstances or kind of better questions to figure out what your objectives are.
I haven't worked through them individually. You mentioned IP investment policy statement. I think some of them do. I know some of them actually generate it, but it's a computer generated one. So in other words, you and I might be putting together X number of pages investment policy statement for a client. They're doing that questionnaire, aggregating what they say their accounts, what they're going to put in the portfolio, et cetera, and they're generating one on the fly, just it's automated. So that's part of the technology base of what they're doing.
I think the Acorns is using the bucketing approach, like, oh, my goal is buy a house, my goal is set up retirement, 529 plan, and they,
Right, probably.
to some extent, that has some, a specific goal in mind.
I was just going to mention that BlackRock also rolled out its free advice component using its ETFs sometime previous year.
Free advice in terms of a
Asset allocation.
robo service,
with
yeah.
their ETFs, just like Schwab with their ETFs.
Yeah.
Is there a point, I know at the end you mentioned that at some point when the account gets big enough, they come to an actual advisor. Has there been any research done to see at what point they do that, or if it's a goals based, once they do reach a certain goal, they actually seek out more?
I think it's too early. Because I don't know that it would be an interesting question to know if Wealthfront and Betterment are seeing any losses. I think it might be a while, and again, I don't think they would admit it. Just like a financial advisor probably wouldn't admit that they're losing an account to a robo. But again, I think we've been in a relatively steady, generally uptrending traditional account market for the last 6 or 7 years. So, and that's actually been one of the criticisms of the robos, is that what happens when something unusual happens. And there was an article I just read yesterday that kind of made that point. What happens when the black swan occurs? What are the robos going to do? And I don't think they're particularly worried about that. It's it's the same question for an advisor, whether an advisor changes because their clients freaked out and they want to protect the account rather than do what they think is the smartest thing to do. But
Do you have any sense how good they are at trade execution?
I haven't thought about it. That's a fair question. It's a good question. I mean, a mutual fund, most of these are ETF based, so a mutual fund based system wouldn't have that issue because it's just going to trade on the close generally, but I hadn't thought about it. I don't know whether when somebody puts money into one of those accounts, whether it automatically buys instantaneously. It's a good question. I honestly hadn't thought about it. Sure.
Is Financial Engines a $10 million cost blank because it's free or because it's kept national?
They don't specify, and it depends on the plan sponsor they're working with, I think. I think they negotiate deals individually. but I'm just not sure. And I think when I emailed this to Sharp, he wasn't particularly happy about my putting it up to 75 basis points, but I put that in there because that's what their ADV says. So I know him, had a long history with him, but I try to be as sharp as I can because I know when I put something like this up, if I make a mistake, somebody's going to get pissed off. And I haven't had one person come back and say I had incorrect information on this table. So not that a zillion people have been looking at it, but plenty of people, and I know some of the custodians certainly have looked at it, and I know some of the people at some of the firms have been following me on Twitter, so I assume they've seen it.
Anybody try to get off the list or on the list?
No, just a couple of foreign operators. In addition to the grid, I kind of list, I don't have all of these firms on the grid because some of them I don't think apply, but I've seen them mentioned, so I wanted to put them at least on a list and say these people have been mentioned in the space, but here's a list of non-US robos. And I emailed Dan over here because he had an article about some of the Canadian ones. So I emailed him back. I said, do you know any others since you wrote that? And he gave me those list of Canadian ones. I think each of those individual European countries has their own unique circumstances that would cause them not to be standardized across the EU. So there's probably more out there, but and there's probably more going to be coming. And again, there's apples and oranges space of all kinds of different firms can offer a product that they could call a robo-advisor relatively quickly and easily. So, but I think these guys, the ones that I've found so far, are really trying to pursue what's happening in the United States and saying this is going to be big. Let's do something along that lines. And again, I tried to mention a lot of these other firms that some people mention at some point in this robo space, but when I look at them, I say I just can't see where the comparability is. And then I tried to list out who I know has not made it, and then I kind of just keep a scrolling list. And it's almost for me just to keep, when I update something that I find, or I find it's an interesting article, I throw it on that list so that I can always go back and find it relatively quickly.
You touched on this, but what custodian are the betterments and wealth fronts using, and how easy is it for someone, if they get their password, to email them and say, liquidate and send me my entire account balance if you're a hacker?
That's a good question. There was an article the other day about a guy that got fired for somebody hacked into an email. That's happened to me, actually. I had a client, I got an email from what the hacker was trying to do was to get me to send him money from his account. And my response was, sounds fishy, but I responded to him. I said, sorry, you know that I only have limited power. I can't touch your money. And then he came back and said, well, can you wire it? And I said, okay, now I know for sure it's a scam. But I copied the client, and they told me right away, and they called the Beverly Hills Police Department. And I don't think anything ever happened to it, but I've seen it happen. There was this report of this one guy that got fired for sending money out of a client account that should have known better from the context. In terms of the robos, I don't know what processes they have. That's a fairly good question. I would suspect that they have some kind of an automated, email. I don't know, a lot of services, anytime you do a trade or something, you get a text or an email right away. So I don't know whether that's happening, but I haven't heard about any reports of something like that happening. I'm not sure. Any other questions?